Hey everybody, Smart Silver Stacker here. The U.S. national debt, it is soaring out of control. Right now we are on the verge of surpassing $33 trillion. But this enormous figure is really just scratching the surface when it comes to the looming debt apocalypse and the implications for the U.S. dollar as well as for the precious metals gold and silver are significant to say the least. And I have teamed up with today's video sponsor, West Red Lake Gold Mines, ticker symbol WRLGF, to tell you about it. More on them later. Now, not only is the U.S. national debt at a record high, but new debt continues to be piled on at an incredibly fast pace, with current fiscal deficits the second highest in U.S. history, exceeded only by those of the pandemic crisis. This is occurring against a backdrop of soaring inflation and rising interest rates. The Federal Reserve's program of debt monetization, also known as quantitative easing or QE, which began during the great financial crisis of 2008, has massively expanded the money supply and devalued the purchasing power of the US dollar. Now, in an attempt to bring down this runaway inflation, the Fed has raised their benchmark federal funds rate at the fastest pace in 40 years, while simultaneously selling billions of dollars worth of U.S. treasuries and shrinking their balance sheet through a process known as quantitative tightening. These measures have brought about the end of a 40-year bull market in U.S. bonds, with the yield on 10-year treasuries moving higher for 3 consecutive years, an event that has not been witnessed since 1787. This sudden increase in interest rates and the cost of debt service has put tremendous pressure on a massively over-leveraged U.S. economy. It has led to an exponential surge in the cost of servicing the bloated U.S. national debt, and according to the latest data from the St. Louis Fed, federal government expenditures in the form of interest payments are now approaching $1 trillion annually. Now, despite these measures on the part of the Fed, headline inflation has remained stubbornly above the Fed's 2% target. As reported by the Bureau of Labor Statistics, year-over-year increase in the Consumer Price Index, or CPI, bottomed out in June at 3%. And since then, the number has begun to rise once again. It's up 3.2% year over year as of July, and most recently 3.7% for August. The trend of disinflation or slowing inflation, which had been much touted by Fed Chair Jerome Powell, appears to have come to a premature end. This is not surprising, however, given the massive deficit spending in Washington, because ultimately there are only two ways to pay for this largesse, through either direct taxation and austerity or through the hidden tax of inflation. And given the political impossibility of the first choice, it seems certain that inflation will remain elevated for the foreseeable future. This trend has put tremendous pressure on the U.S. consumer, who is now forced to rely on consumer credit to pay for the essential needs of day-to-day life. U.S. credit card debt recently surpassed $1 trillion for the first time ever. At the same time, credit card interest rates have hit a record high, and delinquencies are on the rise. The U.S. banking sector is also a victim of the looming debt crisis, with Fortune reporting earlier this year that U.S. banks are sitting on $1.7 trillion worth of unrealized losses due to the declining value of their bond portfolios. As rates on U.S. Treasuries have surged, the value of existing bonds yielding a lower coupon has collapsed. And to fully understand the nature of the debt crisis that we are currently facing, we must understand that not only has the U.S. borrowed $33 trillion, it has accumulated $193 trillion in unfunded liabilities, and this ensures that the borrowing will proceed at an accelerating pace well into the foreseeable future. One problem with this strategy is that for many years, the U.S. has been able to export its inflation and debt around the world by selling U.S. treasuries to our trading partners such as China and Japan. Today, however, the global economy is experiencing an unprecedented trend of de-dollarization, and foreign holders of U.S. treasuries have become net sellers of our debt. This has contributed to the spiking yields on U.S. Treasuries, and it means that we will need to find a new buyer for our debt. When one examines the sheer magnitude of the ongoing borrowing, it should become clear that there is only one entity able to purchase this much debt, particularly if we are to avoid a disaster of soaring rates and exploding interest payments. The Federal Reserve will fulfill its role as the buyer and lender of last resort. The problem with hundreds of trillions of dollars of unfunded liabilities is that there simply is not enough wealth to tax to cover them. They can only ever truly be paid with devalued currency. It's just like Alan Greenspan told us in congressional testimony.
We can guarantee cash benefits as far out and at whatever size you like, but we cannot guarantee their purchasing power.
So when will the Fed end its tightening cycle and revert to a program of quantitative easing and debt monetization? Well, it's hard to put an exact timetable on it, but when we examine the exponential nature of the increase in U.S. debt service payments, it leads me to the conclusion that this money printing bonanza will come sooner rather than later, and when it does, the U.S. dollar will be significantly devalued, and I believe the dollar will be replaced by gold as the world's primary monetary reserve asset. This is likely a significant motivation for the recent rapid accumulation of gold by central banks around the world. Now, I'm not a financial advisor, I don't provide financial advice, but I can tell you that I personally am taking a page out of the playbook of the central banks and accumulating hard assets in the form of gold and silver bullion to position myself for the coming fiat currency devaluation that I am forecasting. And if you're skeptical about dollar devaluation, understand that this is nothing new. The US dollar has already lost more than 97% of its purchasing power since the creation of the Federal Reserve System in 1913, and I believe they are simply going to finish what they started more than a century ago. In addition to stacking physical gold and silver bullion, another asset class that I have been accumulating in anticipation of this shift, and one that I believe will perform tremendously well in the coming precious metals bull market, is the businesses engaged in the production of gold and silver, the miners. If physical bullion is the tool to protect wealth through a currency devaluation, the miners will be a vehicle for growing wealth significantly. And today I want to share with you a miner that I believe should be on every gold bull's radar. Today's video sponsor, West Red Lake Gold Mines, ticker WRLGF. Now, the first thing that I really like about West Red Lake Gold Mines is the location. Their holdings consist of two mines, the Madsen and the Rowan, located in the Red Lake region of Ontario, Canada. As you can see from this map, there are some very big names in the gold mining space operating here, including Yamana Gold and Equinox, well-known names. And the amount of mining activity really speaks to the quality of these deposits and the geopolitically safe and mining-friendly nature of this region. The next thing I like is the team of investors and directors involved in this project. Let's start with Frank Gustra, a self-made mining tycoon. He owns an 11.8% stake in West Red Lake Gold Mines. He's on the advisory board, and in the past, he played a key role in turning Goldcorp into one of the largest gold mining enterprises in the world. Shane Williams, the CEO, was previously the chief operating officer of Skeena Resources, a company which saw its share price rise from just over $1 in 2018 to over $16 in 2021. You've got Tony McCooch. He's a director and the former CEO of Kirkland Lake Gold, a highly successful gold company during the 2010s. Duncan Middlemiss, former CEO of West Dome Gold Mines, a company which saw massive expansion in its market cap under his tenure. So a very successful and experienced team in the gold mining space, the kind of team that knows exactly what to do with the assets in West Red Lake Gold Mines' possession. And that is exactly what this project needs. The Madsen mine is actually a past producing mine whose previous operator bungled the COVID lockdowns and the reopening, which created the opportunity for Frank Gustra to acquire this asset for pennies on the dollar. And This is his specialty. This is what he did to grow Goldcorp into one of the world's biggest gold miner. And now he's working to make a similar story out of West Red Lake Gold Mine, buying up an underperforming, mismanaged asset on the cheap, and then bringing in the capital and the management team that is needed to turn the asset completely around. Basically, the company's plan is to stabilize the project, reinstill market confidence, and then bring this site back to full production status. And what is, in my view, perhaps the greatest aspect of West Red Lake Gold Mines is the valuation, because this is what I would consider a seriously deep value play. At peak market capitalization, the flagship asset used to command over a $1 billion valuation. And today, the total market cap of the company sits at just under $88 million. Consider this. The Madsen project alone has had over $350 million invested into it. They have a state-of-the-art gold mill that can process 800 tons per day. And if you were to try to recreate these infrastructure investments today, the cost would dwarf the original $350 million investment because of inflation and increased construction costs. So investors can get this nearly brand new mining infrastructure at an incredible discount, a fraction of what it cost to create it. Included in the equipment are the gold mill, a state-of-the-art water treatment plant, heavy equipment, and this is a great example of how taking an asset that has suffered under poor management and turning it around and allocating these resources efficiently can be both a huge opportunity and a tremendous value add. The mill is really a critical strategic asset for this company because not only can West Red Lake Gold Mine process ore from its own mines in this mill, but it can also leverage this asset to partner with nearby surrounding mines that lack this type of infrastructure. And if you want to take a look at some of the other shareholders who are involved in this project, in addition to Frank Gustra, the self-made mining tycoon who owns an 11.8% chunk, you've also got Sprott Resource Lending. This is perhaps the most capable and efficient asset manager in the commodity space that owns almost a quarter. You can see that investors are in good company here. So if you like the idea of getting leverage to the price of gold and silver with miners, with producers of these hard assets, and you're looking for a value play in the junior mining space, I encourage you to check this company out, but make sure you do your own research. Full disclosure, I do not personally own shares of West Red Lake Gold Mines, and you definitely should not just go out and buy it because you heard me talk about it here either. I encourage you to do your own due diligence. A great place to begin is westredlakegold.com. I will put a link down in the description where you can find more information about this company. And whatever you do, keep in mind that our debt-based system ultimately will face a day of reckoning, and that day may come soon. And that will be a day when those with real hard assets will be those left standing. Let me know what you think in the comments down below. Thanks for watching, everyone. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.